Hello and welcome. We've been focusing a lot on power on this show, which is all about your company. And today we're going to dive deeper into a newly listed or a one-year-old listed power company. Now, in terms of quality power itself, over the last 1 year, if you see the stock chart, it's moved around a fair bit, and therefore, given those opportunities to buy and sell, the question therefore is this a good time to enter a stock like this? Why is it interesting? One, it's in the power transformer and power technology space. There is a sharp increase in the order book that we've noticed over the last 6 months or so. In fact, the order book, which was at sub 500 or 500 odd crore, it's currently sitting at over 1100 crores. So you've seen a very, very sharp increase in order book. The stock is up 2x since IPO. Not too many stocks in a market like this can say that over the last 12 months. So clearly it's done very well for itself, hit a high of 1100 and has dipped around 20% from that point. So could this be an interesting entry point? Currently it trades at 60 times trailing 12 months. Also, lots of new capacities coming on stream. We spoke about a little bit about that. No debt at the moment. Margin is set to improve. At least there's a positive bias to that, and it has a 20% plus ROCE, and therefore it starts to look very interesting. Now, in terms of what the company does, let's switch back focus, try and understand what the company does itself. It's a company incorporated in 2001. It's an Indian origin global tech supplier in the power space. It manufactures high voltage equipment for transmission as well as grid projects. Metal stroke high voltage components is what it does, and that is largely commoditized. That's something that you want to look out for. And in terms of the products itself, let's talk about those. Let's split those into two. One is power products and one is power quality systems. Power products are reactors and they regulate, restrict voltage and the current in the transmission systems itself. Transformers, they also change voltage levels. That's all within that power product segment that I was speaking about. Instrument transformers, which are slightly different transformers, which control and measure accurately the kind of electricity voltage that is passing through, and that is for protection as well as for metering. That's largely the use case for instrument transformers. And then there are line traps and tuners. These are more signal filtering, and there's communication with the grid infrastructure, which is what those products are used for, which is line traps and tuners. Now let me talk a little bit about power quality systems. Here is slightly better in terms of the value chain. You're looking at stabilizing grid voltage, which is STATCOMs and SVCs, which are FACTs, F-A-C-T-S. That's one set of products which stabilize grid voltage, which is critical for renewable integration of renewable power to the grid. You also have harmonic filters. They remove distortions, if any, within the power supply that is coming through, and therefore it prevents equipment malfunction. And then you have capacitor banks or shunt reactors. They improve the power factor and the voltage stability. So that's broadly the way in which the product is built. Let's pull up those two sets of products which we were speaking about. One is obviously the power products, and second is power quality systems. So that's really the split in terms of the products. Usage, of course, there is high voltage direct current transformers, which is manufactured by Quality Power, and they deal with high voltage direct current, which is harder to do. It's a more niche product line within that transformer segment. So that is something that Quality Power does. In terms of the business model itself, it wins contracts through global bidding with utilities as well as EPCs. It designs, manufactures products post the order coming through. It's a just-in-time kind of a process which they follow. So there is not too much of a time gap between the order win and the execution. In fact, they even right now, it's probably the highest timeline between order win and execution, which is around 12 to 15 months, which is playing out at this point in time. In terms of manufacturing, those are its various manufacturing facilities: Sangli, Aluva, Bhiwadi, and they also have one in Ankara in Turkey. which is the manufacturing facility that they have. They have 7 manufacturing facilities in all. Who do they sell to? They sell to utilities, EPCs, renewable developers, and they have a presence in over 100 countries, which is who they sell to. In terms of contracts, they're slightly longer term contracts. They operate on a purchase order and a project basis. So all of that is what they also cover. They've expanded via strategic acquisitions, the likes of a Meru, the likes of an Endox, which is 2 of their manufacturing facilities. They have been using strategic acquisitions to try and penetrate deeper. In terms of geography, and this is where it really stands out versus a lot of its peers, 68% is export, 32% is domestic. That's really the split. This is FY25 numbers, viewers. That's something to keep in mind. In terms of one of the key pieces here, the raw material requirement especially. That's the whole host of raw materials that are required. A lot of the contracts are fixed price, viewers, so that's something to keep a note of. But margins have gone up surprisingly in Q3. So we'll try and understand as to what's playing out, because some of these, the kind of price movement that we've seen on some of these metals has been very, very sharp. And whether there has been any impact of the war between US, Iran, Israel on the supply chain of some of these raw materials is the other piece we'll try to understand slightly better. Now let's talk about numbers, as we always do on this show. In terms of the revenue, it's done extremely well for itself over the last few years. It's done at 23% CAGR. When you look at the 9-month numbers, it'll surprise you even more, because you're seeing a doubling in terms of the top line from the 337 crore mark in FY25. It's expected to double in FY26. Thereafter, it'll start to probably taper a little bit, but the growth will still be there. Very solid growth that we've seen last 3-year CAGR. EBITDA has grown at 41%, so margins have gotten really, really good due to that. And let's talk a little bit about profitability. 34% growth on that net profit number as well, all the way through FY25. Mind you, listed at the fag end of FY25. So obviously, the equity gains or the replacement of debt, if any, happen only then. Let me talk a little bit about the 9-month performance, and what you'll see on your screen will kind of describe that. Very strong growth on the top line, as you can see. Margins also following through. 40 bips of margin gains that's happened. And then you've got net profit, which is more than doubled over the 9-month period, FY25 to FY26. Right? So you've seen very, very strong tailwind across the board. Now, the guidance was 700 to 800 crore in terms of top line. Might well exceed that. Very, very likely, because they've done more than that in almost every quarter of this year. I'll quickly read out the numbers to you. 177 crore was the lowest top line number in the 9 months for the 3 quarters ended 9-month FY26. And therefore, even if they do that, that's also significantly in excess of the guidance of 700 odd crore, which they've given, 700 to 800 odd crore, which they've given. So they're well away in terms of the guidance. Let's talk about margins now, and let's talk about the order book itself. There you go. You see the margin trajectory. It's gone up. The 9-month FY26 numbers also signal a very, very strong margin of 22% nearly. And that will likely become the base, is what the management has said on the Q3 con call. Let me also now switch focus to the order book, because that gives you visibility, right? That's the order book in rupees crore, 1100 crore in terms of the order book itself. You've got around 800 crore if that were to be a number that is clocked by the company in terms of the top line. That's still a 1.3 maybe in terms of book to build. So you're very, very decent in terms of that. And the management expects to execute this in the next 12 to 15 months, for which capacity we will talk a little bit about. Let me talk about the balance sheet now, because that'll give us a sense as to how the growth tailwind could well be carried. You've got a 500 crore kind of a book value on a 6,500 crore market cap, mind you. So it trades at 13 times book. So certainly not cheap in that sense. When you're looking at the borrowing number, it's around 36 crore. So really no borrowing whatsoever, no concerns there. The cash component within the balance sheet is around 200 crore. So it has a decent amount of cash also that it sits on. That's the cash flow from operations. You've got a decent trickle through from cash flow to from EBITDA to cash flow. but working capital requirements have gone up for the business. So that is something we will talk to management about, try and get an understanding as to what's playing out. My guess would be the raw material that they are having to build in terms of stock, given the kind of or the trajectory of the top line, could well have influenced that number in terms of working capital. But that's on balance sheet and cash flow both. Let me now talk about the return ratios. Again, impressive numbers there. More than 20% across the board, all 3 years, FY23, 24, 25. Very likely will do the same in FY26 as well. In terms of shareholding pattern, again, no concern, 74% held by promoters. And then you've got stakes by FIs, DIs as well. And then you've got the public holding nearly 20%. You've got 2 analysts, and therefore we've not put that here. 2 analysts with a buy rating, 45% upside is what they see. In terms of the valuation, they're giving this, excuse me, they're giving this FY27 a 50 times earnings and FY28 a 31 times earnings. So you'll see a rapid compression with regard to price to earnings. We'll have to wait and watch as to whether that can sustain. The current capex can take the top line to 2,000 crore on a 22% margin. So that clearly signals very strong robustness in terms of the business tailwind if the orders continue to play through and if the Middle East doesn't impact the top line. That is how it stacks up. It's one of the best charts that we've seen in terms of overall performance on most parameters except that valuation piece where we remain a little bit cautious. Now, what we'll do is slip into a very short break. On the other side, I will have Mr. Pandyan, who's the Managing Director and CEO of Quality Power, join us, give us that perspective on the way forward. Mr. Pandyan, we'll just keep you there waiting for a couple of minutes. We'll come straight to you. Well, we did do a quick analysis on Quality Power, and we're joined by Bharanidharan Pandyan, who's the Managing Director, CEO at Quality Power. Mr. Pandyan, great having you. Give us some perspective, first off, with regard to all that's playing out geopolitically. Is it impacting you in any fashion, both in terms of order wins or in terms of your supply chain for sending product or receiving raw material?
Good afternoon. I would say we live in a globalized world. None of us are, isolated to say that, we are not impacted. The good news first, I think the order wins are still very, very strong. I think the demand-supply mismatch in the electrical transmission sector still is very strong. I think our current order book stands north of 1,200 crores. We have more projects coming up in this next quarter. With regards to supply chain, we have seen an immediate impact of pricing. That is anything related to polyester, that is resins, paints, and oil, especially in the instrument transformer segment. Apart from it, on the logistics trends, on the incoming side, most of the incoming side is coming from the Southeastern East Asia perspective, so I don't think there's been problem. If we see any problem, that may be on the exit side, where we mostly ship to the west of the world, say the US, Middle East and Europe, because we are still, early in the month for dispatches. I believe we would see the full impact of it at the end of the month if we are having shipping troubles. But apart from it, from an operations perspective, we do face some challenges here and there because of the shortage of LNG at vendor works. We are trying at our best to be able to negate it or reduce the impact in the operations. But all the operations per se at this moment are currently fully available.
Okay, that kind of comprehensively gives us a picture. Mr. Pandyan, talking about the business itself, what happens when some of these raw material prices start to creep up? Because my understanding is that your contracts are fixed priced. You aren't able to pass that through to your customers. Give us a perspective of what happens, aluminium, copper, when it rises. Of course, aluminium today is down, but outside of that, and how much of a margin impact do you absorb? And how much can you pass through?
So we have given a guidance which is quite conservative from our estimate and what we say. I believe we should be sticking to our guidance at this moment. There can be challenges at a monthly level, but I think at a yearly level, most of these escalations are factored in our cost when we go to customers. We do believe that there will be some increase in oil and metal prices over the next few quarters, and all the new contracts that we may be signing in may be at a higher price. And if and when it corrects these metals, I think at that time we would make up for the couple of percent margins here and there. So at this moment, there's no bad news on the margin front.
Very interesting. And how does the China factor play out on pricing? You spoke about pricing and how you tweak it. Does Chinese supply impact the kind of pricing you have? Where do you get competition from? Because you're largely global, right? And why and how are you able to insulate yourself from that Chinese competition?
I believe at 800 kV or say 500 kV HVDC or EHV transmission level, it is just not the technology, it is also the geopolitics which works around the choice of a manufacturer. These equipments normally have between 25 and 40 years self-life, which means the spares that may be required for most of the utilities would be in next 2 or 3 decades. So geopolitically, I believe India is in a very good position with Europe, in Australia, Middle East, and the US. So the choice normally is not determined by price, but by reliability, performance, and again, the geopolitical conditions. We are doing some HVDC in Australia at this moment, 500 kV links. We are expecting more in Southeast Asia. On the fact side of the things on StatComs, we have more contracts that is coming up in India, North America, and Europe, where we really don't see Chinese. Even if we see the Chinese, we are able to compete them at the margin levels that has been guided.
Let me close the loop therefore. So pricing, you're fine, and therefore you are able to undertake price hikes, which should aid your margins going forward. But for the moment, you've established a floor and you've said that margins won't breach the 22% number. You're currently clocking 27. How much of the copper aluminium pricing is already built into the 27% margin that you're doing? Because from what I understand, or probably what I'm gauging from you, you seem fairly confident that your margins won't breach 22. I'm trying to understand how much of the copper aluminium price increase is already factored into that 27% margin you've logged in Q3.
So let's assume the last month when the aluminum prices are higher, we buy aluminum and copper on a daily basis. So it's not, we don't stock aluminum or copper just in time. So whatever we bought last month would have been at a higher price. What we are buying this month is at a lower price. However, the contracts what we signed last month were on the prices of last month. So we would have these revolving margins between quarters, but at the end of the year, I think it would be fairly stable. That is how much of the electrical industry works per se. We are no different to them. And I believe the margins at this moment, I'm still sticking to the 22% because the impacts have been minimal. We do not have a lot of freight coverage at our end. However, let's assume if the customers don't pick up at the end of the quarter, primarily because of the shipping crisis, we may have some small work in progress that is stuck on our books, but that's about it. So that's why we are slightly confident at this moment on the numbers.
Quantify small. Will it be triple digit crore or will it be double digit crore?
I would say at this moment, double digit.
Point taken. And thank you for being candid. Also, the other piece is with regard to your FY26 numbers itself, therefore. Let's exclude this double-digit crore impact, right? Would Q3 largely be the base in terms of the revenue which you will start to clock? Because you're now growing at a very, very healthy clip. Can you kind of sustain that, or can there be chinks in that sustenance outside of this temporary blip that you might see in Q4?
So Q3 is not technically the base. It depends because as we are a largely global company, when we work with European markets, September is our largest quarter. If it's mostly, say, Turkey or the US in December, because that's how the projects are normally pushed into. I believe Turkey ended the year in December, so we had a big jump in the quarter. India would start with the same numbers, the Indian operations of Quality Power and Meru. But Turkey being a Q1 would be slightly soft. So I don't think Q3 is the base. Having said it, we have guided that we'll have an S-shaped curve between 15 and 20% is what our expected growth level next year are based on this year's as a base. I believe this year's base would be north of 800 crores, which means that we will be guiding close to 1,000 crores plus next year.
And with a 22 to maybe 25% upside bias to the margin, because you would have built that into the forward contracts that you signed beyond the 15-month threshold, which you already have on your order book?
I believe at this moment the guidance is about 20% on a long term for all accounting purposes, but those have been already built in unless there is very big spikes on more than what it's already available. But apart from it, I think the order book is, as I said, north of 1,200 crores, and we still have a year to go in.
From what I understand, Mr. Pandyan, correct me if I'm wrong, currently you're at virtually 100% capacity utilization on most places, except the new capacity that you're ramping up. Talk to us about the timing of that, because there are certain audits which you need to complete. For example, at Sangli, where are we at that in terms of the timing? When do we expect to complete that? And say, what is the FY28 number that one can look at? Because my understanding is that it will depend on Sangli and Meru, of course, coming on stream in a big fashion.
So we have about 30 or 40 different audits on the plant by various customers on the HVDC front, apart from the utilities. So I believe it will take us about 6 months of audits. We were attempting a trial production run starting from June. I believe it will be shifted by a month. Primarily because the PEB guys are unable to deliver the last sections because of the LPG shortage. But we would still try to attempt a June starting of the plant to be able to ensure that by the end of the year, we would have covered most of the audits. Yes, our plants have been sweating 100% at this moment. The new capacity with full utilization, I believe we should be able to attempt by December. Where we would start taking in much larger orders. So Q4 of this year, of the next year, would give you kind of a base of what comes after that. Our focus at this moment is to push on the order book so that we have enough to eat when we start the plans fully.
Okay. Mr. Pandyan, unfortunately, this is all the time I have on this edition of All About Your Company. But thank you so much for joining us and being super candid, by the way, with regard to how you're seeing the business evolve. Viewers, that's unfortunately all the time I have. Thank you so much for tuning in and watching All About Your Company.